No idea why there was a problem before. Okay, so apologies for wasting your time on that for a few minutes, but I will make it up to you because I've got some phenomenal slides and a heck of a lot of information to take you through. So sorry again that it's all working. Now, let me, on that basis, start sharing some of the details of what I want to show you on this webinar. And I hope the time has worked out okay for everyone as well. I'll keep an eye on the chat whilst we're at it. If I look off screen, it's because I've got multiple things that I need to show you during the course of the webinar. So let's start off with a nice little screen share, shall we? So that you can see everything, make sure everything's as I want to show you as well on here, which it is, so I can see your questions as we progress. So I will keep an eye on, obviously, the slides, but I will keep an eye on the questions as well. Apologies once again for the slight sound error that we had over there, and I'm going to keep an eye on the chat. What I'd like to do is just start off, as ever, with a little bit of a poll, display the results at the end of the poll, just in terms of where you think the markets are at. Now, this is the public one. So for those of you on the Great Investments Program, don't have a heart attack. This is the public one. You'll get the latest this evening or tomorrow morning for those on the program, okay? Because sometimes, well, it's usually one person on the program has a heart attack that I'm speaking to the public and they'd like to lock me up in their cellar. Patel on the market. So, as I said, for those who are clients of the Great Investments Program, you will privately have the latest full version later tonight, this evening. This is the public one. What can we see and what's happened most recently? Well, you have seen China's calmed down, all that's gone. UK visit has shown that the UK is getting some beneficial treatments. Microsoft is investing in the UK 30 billion. To put that into context, the UK is the 5th largest economy in the world. The 4th largest is India. Microsoft's only investing 10% of what it's doing in the UK into India. And the reason for that is, as they've explained, is just how far ahead the UK is in AI. Now, 30 billion is a lot. The intellectual property, of course, will be owned by Microsoft. So if you're a Microsoft shareholder such as I am, great news. Is it good for the country? Well, that's not what this webinar is about. This webinar is about stocks. So is it good for Microsoft? I believe so, because they're getting their hands on a hell of a lot of British talent. One of the problems that exists in the United Kingdom is we have some extraordinary talent out of some amazing universities. I'm talking about the top 0.001%. I don't mean, hey, Alpesh went to a good university, he must be clever. No, I'm mediocre rubbish compared to what we're talking about, the people who are the patent creators and the Nobel Prize winners. That's who Microsoft want to get their hands on, the next set of AI Nobel Prize winners, and that's what they've got as a result of this. So that deal is incredibly good for Microsoft, so I'm glad I'm a shareholder. Is it incredibly good for the UK? Well, yeah, because we don't have that kind of money. The UK doesn't have, if it has 30 billion, it'll spend it on rail links to Manchester from London. It's just not doing what Microsoft's spending it on, because it doesn't have the expertise. Even if it threw the money, Microsoft has the expertise. So it is good for the UK. It does deliver on that promise of AI superpower. So none of this is political or partisan. Couldn't care less about the politics. I'm talking about the stocks. And it's going to be definitely good for Microsoft and Amazon. And you've seen NVIDIA were there, and so were OpenAI, which Microsoft has a whole chunk of money in as well. So good for those big companies, all of which, if you follow my webinars, you know I own. Okay. Now, did I buy them because I knew there was going to be a state visit through the 47th president? No, because I don't have a crystal ball or a time machine. By the way, if you want to know the brains behind it, and credit to the British government for focusing on AI and making this happen and those kind of numbers happen. And I couldn't care less which color the government was, whether it was, red, blue, yellow, gold, orange. The point is, Varun Chandra, he's the Prime Minister's Special Advisor on Business. Varun works with the Office for Investment and obviously with number 10. If you saw little glimpses on the dinner in Windsor, there was an Indian bloke. I think there was one. That's Varun. If you saw who was doing the Q&A when the announcement was made at Chequers with both President and Prime Minister and holding the mic, that was Varun. You missed him. he's got the special relationship with Silicon Valley and all of those executives. What's extraordinary about this visit, and it's not partisan at all, any of this, is that those numbers are the size and scale we've not seen for Britain, and only America can deliver those. Why on earth we weren't doing 2 state visits before every single time, who knows? But also because America's economy is that big. So the stocks that I have, I am so pleased, because think about it. I own a company. My son owns the 7 companies of which we have stakes in. All the heads of those companies went to see the Prime Minister of the United Kingdom with the President. That's pretty bloody good companies to be owning. Well done, Alpesh. You own companies with that kind of access? Yeah, I own companies with that kind of access. The good news is they're publicly open to everybody. Why doesn't everybody do it? Don't know. They have all sorts of biases and all sorts of other things as well going on, which is why they don't do it. Now, I just checked the chat box. I was expecting to hear a whole load of comments and vitriol against either governments or heads of government. Were focused on stocks. Keep your focus, keep your head in the game. Okay, so all that's good for my stocks in a broader picture. India, he seems to have backed down. It was the Indian Prime Minister. I mean, there was a concern about these 100% tariffs. Is that part of a bigger, broader war? And what does it mean for the US and the UK markets if he's going to get more aggressive again? What does it mean for world trade? Nothing. He seems to have backed down. He called the Indian Prime Minister up on the Prime Minister's birthday, and they're getting on with negotiations, and some of the tariffs might come down. Put aside the aggressive way in which Peter Navarro, the trade advisor, did it. The fact of the matter is, 25 years ago, when I was on the UK-India Roundtable as part of a team appointed by the UK PM to work with the Indian Prime Minister's office, we've been saying, please reduce your tariffs for 25 years, but we've just been doing it rather politely, which is fine. And you should be polite and respectful, as William Hague said, to a proud nation and proud civilization. There's a way of speaking. And you might as well, if you speak like that, you don't get anything and you don't get anywhere. Quite frankly, the areas in which India will be opening up tariffs, it's a grown up economy. It's the 4th largest in the world. In those specific areas, it can handle it. I agree it might not be able to handle it in farming, but in those it can. So is it time to bring it back to stocks, head in the game? India ETF. Well, the problem with the ETF with India is not so much, obviously, long-term growth fully expected. It is, if you project forward, just put it up on Google Finance or whatever, or Yahoo Finance, it's free. The rate of growth isn't that great. So sometimes these charts can look like, wow, it's just going up and up and up. And people don't go one step further, which is, okay, what happens? All the companies that I have as well, they were going up in that direction. I don't think Tim Cook was there, was he? I'm not sure if he was. But anyway, going up in that direction. But they're not going at the same rate of growth. Speaking about Intel, so as you know, the US president basically turned around to Intel and said, you're going to give me some shares. All fine, don't have a problem with that. Why the British government has not taken more stock in companies, obviously went through a privatization scenario in the 1980s, of which I was a beneficiary, obviously, because that's when I got into investing. But then we'd never bothered to buy shares in private companies which are doing well, doing what you and I are doing. Okay, the American government has decided, wait a minute, why don't we buy a bit of Intel? It seems the only bloody chip maker on the planet of any reputation, size, scale, which is on its knees, and we're going to get a bloody bargain. And then he says to NVIDIA, now do a deal with them, like a mafia boss. That's fine. I have no problems with any of that when I'm talking either for my country or if it was America or for my portfolio. And of course, it went up 29% yesterday because NVIDIA said $5 billion deal will do. None of that was obvious. None of that was on the cards. So it was speculative. So if you missed it, fine. I wrote a piece for my private clients on Telegram about 2 months ago, or a month ago when this happened. But I made very clear that just because he's got a stake does not make this 100% in 12 months. Now it looks like it may well do, but it didn't make it a sure thing by any means. If you like that kind of volatility and narrative, that's not for me so much, but if it is for people, then fair enough. So yeah, the US government has just made a ton of money on its stake in Intel. I don't know if the trade went through at the lower price. I expect if it didn't, Trump would not have got them together and made a deal round a table Intel, you're crap, give me 30%. If you give me 30% of your company, I'm going to get NVIDIA to give you $5 billion and save you. That's what a deal is. That's what being a deal maker is. And that's what he did. It's really simple, honestly. And I can tell you because I have a role with the government. I don't know if you know this, for the last 20 years for the UK government. And I have a business card which says Alpesh Patel, deal maker. That's what it is. My deals, I wish they were that big. They're not. They're smaller. But it really is. If you do this, I'll get you this. Right? And you do that all day long. I do it on smaller scales. It's all it bloody is. Well, there's a lot more to it than that, but you need the networks and the credibility and all the rest of it and the access. But the point is, that's what he did. Yeah, it's pretty bloody simple when you look at it. Now, he might be rubbish as the president and other things, but on that Intel thing looks good for Intel. It'll still be a bumpy ride because anything to do with Trump is bumpy. Okay, so those are a couple of things I wanted to mention. And basically, bottom line, all good. I've not had to sell anything on the portfolio, despite all of what's been happening. And we'll go through the portfolio again. And I've already told you, if you follow this, what I own. Basically, pretty much everybody was at that dinner. I own some of their stuff. Yeah, I mean, Jacob, I think so. Yeah, against China. I mean, instead of just blocking and saying, oh, private sector, private sector, private sector. No. And I said on BBC about 5, 6, whenever the financial crisis deepened with the debt crisis with Greece, what was that, 7 years ago? I said, why don't the Germans, instead of giving the Greeks a ton of money to bail them out, why don't they just say, we're going to buy some Apple stock for you, and the profits off that is what you're going to live off? And by the way, by now, they would have wiped out their deficit. Not only that, through quantitative easing, Britain printed, I think it was close to $1 trillion, 800 billion, I think. Okay. Guess what it bought with it? Real estate? No. Pieces of China? Nope. Guess what it did? Bought bonds. Stocks in Amazon, Alphabet? No. Bought bonds. Guess what's done better? Well, it's now selling those bonds at 20p on the pound. Guess what those stocks that I talk about every single bloody week. Now, I get tired of saying, I wish they'd bloody listen to me because it makes me sound arrogant. But anyway, the Americans are listening to someone. More money is going to be going into the US stock market. One thing's absolutely clear. This president loves the stock market and he loves crypto. This announcement about themed ETFs. Now, this is not to say I won't be buying any of these, just so you know. Okay, because I don't go for narratives and stories. The way in which I look at things, and I'll share with you how I look at things in a moment and how we do things. Now, again, none of these stocks, for instance, meet my criteria. So any of my clients thinking, heart attack, Alpesh has just shown the Holy Grail and the crown jewels. No, I haven't. None of these meet our criteria, and that's the point I'm making to you. None of these meet our criteria. We do a similar way with exchange-traded funds. So unless I've seen the data on this, I will not be doing it on a narrative, and that's an important lesson to teach you all. Don't do things on narratives and stories. Make sure that you've actually seen stuff, and that's why you're doing it. On why and how it should be. Jacob, you're 100%, absolutely 100% correct. Well, in a way, they're risk averse, but by being so, they're taking far greater risk, if you think about it, but anyway, we are where we are. Animal spirits, S&P posted another record. It just keeps going up and up. Now, it's important. This animal spirits term comes from Keynes, the economist Keynes. It's the X factor. And there is an X factor of gains. One thing which is underestimated with stocks and the market is momentum. You see, what people wrongly think is, Alpesh, isn't the stock market overvalued? Well, what you're saying is valuation is the only metric on which you can buy today and go higher tomorrow. What you actually are implicitly saying when you say, isn't it overvalued, is valuation is one metric. If it's overvalued, is there an increased probability for somebody who's risk averse of them suffering greater downturns? That's really what you're saying, but you've not said it like that. And we're going to look at the S&P in a second in detail and break it down. By valuation is one factor, but there are other factors. So yes, if valuation is high, there's an increased probability of a fall, but it's not necessarily so. So for those who wrongly think it's overvalued, therefore it must fall, I will stay on the side of the tracks whilst the train leaves the station on the basis it'll come back and I'll buy back cheaper later. They've often seen themselves waving goodbye to trains, okay, which have never come back. So I want you to understand that part as well on that as well. Are there any clients on the call? If not, please share some tips outside quality 5. Well, I'm not a tip sheet, Ronnie. So if you're watching this for tip sheets, it's for education information purposes. It's not tips because it just cheapens it. So I'll talk about other stocks, but sorry, you're at the wrong webinar. If you want a tip sheet, go look at Jim Cramer and Lose a Fortune. I'm going to talk about how you build a portfolio and not just a stock here or there, because the danger is you're going to blow up. You're going to sort of say, oh, thanks, I got that company and it did really well. Now I'll go gamble on somebody else and gamble on somebody else. There's a load of people on TikTok who'll give you loads of companies you can just speculate and gamble on, and then I'd go and take the winnings to Vegas. But this is the wrong webinar for you if you want tips. Hot stocks and cold returns. I've got a ton of articles on Campaign for $1 Million. If you look there on the blog, you will see a breakdown of why retail clients start trading and they go for fear of missing out. And this is why they lose money. Okay, so what we do is we build portfolios, and I'm going to show you some of the portfolios, how we build them and why we build them, rather than just saying, oh, you know what, I really like this high risk company and it might go up. Hey, playing with other people's money, that was what you would do. You just say, here, roll the dice, go take this. What the hell do I care? I'll never see you again. Okay, this is not what I do. It's not who I am. S&P 500, where are we on this? Now, I do own the S&P 500, both 2 times leverage and single ETF. Okay, so does my son, so does my wife. Now, the reason we do is, well, the thing with exchange-traded funds, which is very easy way to make money, not guaranteed, but an easy way to make money, is we can just use that as a signal, the monthly moving average. Okay. The monthly moving average convergence divergence. It's just an easy way of doing it, right? So we like to do it. Well, they don't do it. I do it for them. And basically, when you get across to the downside, you're out. And when this flattens and starts rising, that's the earliest you get in. Okay, it's very simple. Now, sometimes do you get wrong-footed? Luckily not there because it never crossed below. But here you end up taking an insurance policy because it did move below, so you exit, and then you have to buy back a bit more expensive later. That's the insurance policy. That's the insurance policy, and that's the cost of it, okay? There's no, it's a good question. There's no particular reason other than they behave rather differently. They are correlated, of course, to each other, but they behave rather differently. And what I would say is nobody on here should be doing leverage, because I don't know who you are and leverage is risky. It would be incredibly irresponsible for me to do a webinar just speaking about leverage without mentioning that with leverage, what that means is if you fell asleep at the wheel and assume you will, then that drop would mean you lose half your money on a 2 times leverage. And somebody foolishly is going to do rather well by accident and do 3 times leverage and lose almost all of their money on the S&P 500 as a result. That's the bit nobody ever tells you. If you want to know what risk is on an image, and by the way, all of this you could get from Google Finance or Yahoo Finance. Drawdown is this, okay? So the peak to trough. Drawdown depth and duration until you're not underwater anymore, i.e. until you go peak to peak, right? The bigger the triangle, the more the risk. Smaller the triangle, less the risk in a particular instrument, okay? Now, why is that important? Well, when you look at things, I generally like things which go like this, obviously. Obviously, don't we all? Wouldn't we all? Why wouldn't we all? Okay, but if you get deep drawdowns and long durations where you're underwater, you're taking more risk, and your ulcer index goes up. So my definition of the ulcer index is big drawdowns, long durations, all right? So ETFs, broad ones like the S&P 500, which actually, to be honest, is a portfolio of 7 stocks, as you all will know. Okay, Meta, Microsoft, Apple, Amazon, Alphabet, throw in NVIDIA and one other, possibly Tesla shoved in there as well. And that's all it is, because it's weighted by capitalization. It's a portfolio of 7 companies. And because it works on this very simple strategy, and because it's very easy to see where you are at any given time. So where am I at the given time? Well, we're overbought. In other words, you're at the top end of this. Now, does that mean it's about to fall? Well, it might do. It has done in the past. Okay. But does that mean I sell today? No. Here's an important education lesson I really want you to bear in mind. So of the 10 things I said in the email that I said, I want you to bear in mind, just because something might happen in the future does not mean you take action today against it in the case of the market. So when I do these broadcasts, I say to people, look, I'm not selling this today because it's not what I call a daddy bear. So I'm still in, and that's fine. Would you get in today? Well, you've got to decide on your risk appetite. What private investors think is it's some kind of guess. Alpesh has got a crystal ball. He can see into the future, and he's going to say to us, this is exactly what's going to happen. Whilst that would sound incredibly sexy and make me look really good, it'd be bullshit. Because in actual fact, what I'm going to tell you is I don't know what the future holds, but what I know is today I don't need to sell this. And if I was risk averse and didn't own any of it, would I buy more today? Well, I'd probably buy at a smaller pace than if I was risk loving. If I was risk loving, I'd put everything in. Obviously, the way you make decisions is you try and turn them into either binary choices or into a sliding scale. There are only two ways. You never need to do anything when you're making decisions, okay? And with this, if you're risk averse, sliding scale, you don't go in. If you're risk loving, you go all in. And if you're in between, you edge in, maybe each month, put a certain percentage in if you want to be in. But it is overbought, so be warned and expect falls. I hope all that makes sense. Yes, it will, Chetan. Indeed. Forget that for a moment. What are the earnings calendar? Well, these are some of the earnings that are coming out. None of these are going to move the markets, okay? And if somebody put a gun to my head and said, which one of these do you happen to like the most? But, and here's the important thing, when the markets are overbought as they are now, if you risk on individual stocks, which is what retail private clients do, you are increasing your risk. You're an absolute idiot, basically. I'm just going to call it the way it is. If you're going to sort of try and find individual stocks, you need to create it as part of a portfolio because the markets are overbought and there's increased risk. So you should be looking at it as a whole, as a portfolio. And the reason I say that is this. Warren Buffett became the world's richest man, but in no year ever did he have the best performing stocks in the stock market of that year. And in no year ever did all his entire holdings rise. All right. So he always looked at it as a portfolio, and that's particularly important in a market which is overbought. What does overbought mean? It means if you drew a line between here and here, and these are the average, short and medium to average price of the S&P, then it's in the top third. Okay. That's what it means. And which means there's an increased probability of falls, but not a guarantee. So I'd rather be looking at, say, an AutoZone as part of a broader portfolio. What's the past week done roughly? This is not bang up to date. Okay, so private clients, you'll get it after market close. The Great Investments Program private clients, you get it after market close. Okay, because I can't give you the data before it's done. Incredible in a week. Incredible in a week with Oracle. Now, Oracle did it just off the back of an announcement. It's not that they had the money. It's like saying, I'm going to have a $300 billion deal. Whoa, Alpesh, we're going to put your stock price up. That's why the stock market is probably the easiest, quickest way to get rich because companies get multiples on their profits. You and I, if I said to you, I've got a house and the rent is, I don't know, £10,000 a year, you might say to me, okay, Alpesh, if it's £10,000 and there's a certain, no, forget house, just any asset. I've got an asset. The income you're going to get from it is £10,000 a year. You might say, okay, I'll pay you, I don't know, a year's worth of income in advance. And you say, great, I've got rid of it. I got a year's worth of income in a day. In the stock market, I'll pay you 20 years worth of income today. That's what it is. It's the multiples that make you rich as well. Great, Jacob. No, good as well on that one. Now, Microsoft, Apple, over the past week, these Broadcom, Walmart, there'll come a day when I go into Walmart again. Today's not the day. Costco, similarly, they are on various factors, value, growth, income, cash flow, too expensive, okay? So didn't want those. The basis on which, just so people know, clients make decisions, or I make decisions, and clients can decide to like those decisions or not, is we need these 5 things to be green. Now, just for the sake of any clients, none of these are suitable. Why are they not suitable? Why do you not like rank group, Alpesh? Well, because it doesn't hit enough of the criteria. What are the criteria? Well, we want undervalued companies which are growing, that's what this is, and producing dividend yields. Why? Because the data and analysis, not from me, but from academia, shows that that's a more important factor to stock prices moving. It's not a guarantee, sadly. Nothing's guaranteed. Croaky comes from Goldman Sachs Wealth Management. Momentum comes from the hedge fund industry. In other words, trends tend to continue, but they're not guaranteed to. That doesn't mean these stocks won't go up. It doesn't mean that at all. What it means is there's a better team that I've got of stocks, which will help me sleep easier at night. Okay? Sortino is average returns, high average returns, and very low. Those triangles are small, basically, is what it means. The drawdowns are small and the rebounds are quick. But none of these currently would make the cut. It doesn't mean they're not going to do well. A bit like if you didn't go to your first choice, let's say you apply to Oxford University, you didn't get in, it doesn't mean your life is ruined and you're going to be rubbish. Okay? You can still win the Nobel Prize in economics. Don't worry. But that's the way I choose things. And the reason I choose those is because of the works of 3 Nobel Prize winning economists, Daniel Kahneman, Eugene Fama, Richard Thaler. Now, what about some of these other areas? Now, some people, because they've heard of names like Netflix or Disney, they will pick on that basis. I will not pick on news or narrative, and that's really important. And again, because there's lots of research showing it's not a good idea. I've published that research in my books. If you'd like a free copy of the book, I will give you that file right now. There you go. You can download a free copy of the book where all of this is put into detail. Tech is what everyone's focusing on. Let's just look at this for a second. Why do I then own, as anybody who's followed me on these calls will know, why do I own JP Morgan and Goldman Sachs? Well, because they met the criteria. I don't do top down, i.e. which sector is something in, I like that sector, so I'll buy into it. I do bottom up. And if the numbers meet whatever area they're in, then so be it. Okay. Healthcare has taken a beating in the US. Does that mean I'm bottom fishing? So here's another important lesson. I don't know where we've got to 1, 2, 3, 4, 5, whatever it is. But of the 10 important things I wanted to tell you in this, just because something's fallen is not a reason for me to buy. And it shouldn't be for you either in and of itself. Because then, again, you're speculating. I'm trying to get people to stop speculating and start getting rich instead. All right. And as you can see from this, this is before the Intel 29% went up. All right. Now, let's look at the past year. Now, one thing I can tell you, and here's point number 6, this is going to happen again. Maybe it'll take 2 years. See these numbers, but it won't necessarily be in the same stocks. So one of these is going to go up 25%, but it might not be Amazon. It might be Alphabet, and Amazon might be the one that goes up 61, et cetera, et cetera. Okay. The index, the S&P, is broadly based on these, but by the size of these cubes. The bigger the cube, the more influence it has on the movements of the S&P. So the S&P is really an index. If you said, well, I don't know where to even start. Well, you're buying these by the size, the bigger the influence they have on the index is these. Now, here's the interesting thing. Apple's been a laggard. What lesson I want you to learn, because I've heard it over the years, is, oh, well, they stopped innovating, or I don't think this product. That's not your job to worry about whether they're innovating or not. Your job is to say, does it meet the various criteria? And if it does, then leave it. By the way, Warren Buffett has, I think, a quarter of his wealth in that. And I'll show you his portfolio in a second, okay? People always ask me that, which is the most important? They're equally important. If I could rank them, then I would just tell you one stock, wouldn't I? I'd just keep ranking until I get one stock. And then I'd say, just buy this one company every year and don't do anything else. And if you want to know what that is, okay, if you want it, just give me one stock for the next 30 years. You'll never do it. But if you want it, okay, see any of these big green ones, any of those. So you can pick this for the next 30 years, but you won't do it and nothing else. All right? Any of these big green ones. Pick them and nothing else. Maybe even that. All right, if you just want me to tell you which is the most important and then go a bit further and say, well, which is the most important criteria? Now with the most important criteria, which one's going to get to the World Cup final of criteria? There you go. Just pick any of these big ones for the next, but you'll have to give it a longer time, next 30 years, and that's it. But you're not going to do it. Nobody does it because everybody likes the dopamine hit and the rush. Okay, and personally, I wouldn't want to just have one stock for 30 years because the volatility is too great, because I want to have the opposite of the dopamine rush. That's why I have a portfolio. Right? And I don't have a crystal ball to tell you that if you do this in 30 years, you'll come back and say to me, oh my God, Alpesh is a genius. I've just made a freaking fortune. Although that will be the case if you just bought those for the next 30 years. But people don't want to do that. Retail clients don't want to do that. They want to sort of chase narratives and stories and have the dopamine hit and the excitement and run around like a cat chasing its own tail or a laser beam or something. Okay, so these are important lessons, but they're boring. It's the boring teacher at school telling you to be boring. It's the tennis coach telling you to keep hitting the ball against the wall. Who the hell wants to do that? They just want to go play in the final at Wimbledon. Okay. Now, let's look at the markets over the past year and what we've got. Well, the NASDAQ's up 24%. And yes, I have a NASDAQ tracker. Do I have 3 times leverage NASDAQ? Yes, but I'd exited that slightly during the course of this year, as you will know, around February time when the tariff thing, or February, early March, when the tariff thing was biting in and it became a daddy bear. And I knew the danger was if the market doesn't fall, I might have to buy back more expensive later, which is what happened. Well, that's the insurance cost. That's the insurance cost. If you didn't want to pay insurance, as in the case of the NASDAQ, and the house didn't burn down, which it didn't, i.e. the market didn't crash, then you might feel smug and clever. But one day you're not going to pay insurance and the house is going to burn down. Okay, it's why we all have house insurance. Now, for me, that meant getting out in February or end February, early March, and then getting back in May or June time. And that meant getting back more expensive, but that's fine. Okay, so I missed some of the falls and I felt very happy. It meant I missed some of the gains. You might not want to do that, and that's fine if you don't want to. Then you got the full 24%, 3 times leverage. You got 75% in the past year. Okay, I didn't get 75% in the past year because there was that period where I had to exit and then get back in a bit more expensive. Leverage is dangerous. It's not a magic bullet. I suggest nobody does it. Don't do it. Okay. Do you do short-term rebalancing when there's big moves like that, for example? No, Jacob, leave it for a year, only because I'm lazy. I'm lazy. It's a bureaucratic nightmare. I'm not trying to be perfect. I know one of the tricks to making money is being happy and able to leave a lot of money on the table. Okay. In other words, I know that if I spent more time, energy, and effort and try to get things quite perfect, I might make even more. In the same way, I know if I work my ass off, I'll get a 6-pack, and a 6-pack's worth having. Just imagine, how much fun I could have with a 6-pack. I just walk around, right? I don't want to do it. And it's the same with investing. I'm all right. Thanks. I don't want more and more and more. I want to get it right and then leave it alone to maximize as best I can my return on time invested. So we are with the NASDAQ. The Dow, not so much. The Dow's only got 30 stocks. We'll look at some of those in a second. So how's the week gone? Now, some of you will famously know I don't own Tesla. I have at various times, so I don't. And the reason I say this is to make a very clear point to you, and this is point number 7. It's all right having companies which you think will go up, like Bitcoin or Ripple or Ethereum, all of which I have, securities that I have. But saying, well, actually, I don't want more, or I don't want some things, which even though I know they will go up, or I'm pretty sure they'll go up over 3, 4, 5 years, like Tesla, I just don't want the volatility. And I believe today it's up a bucket load. I don't want the volatility. Thank you. We're all excited when it's going up, but I just don't want the volatility that goes around the man. And part of it is I wanted to do it to show people a lesson. You don't need to own everything. You don't need to keep chasing it. It's better to have, well, actually, I want to do things in a way where I'm happy with the returns. And if I miss some greater returns, that came with greater risk, and I'm happy not having them. Okay. With the rest of this, you will know from what I call my Quality 5 Plus, or what my son and wife own. Now, why do we have those? The reason is, well, that is one reason, but there's other reasons that something could end up in my portfolio. It can also end up in my portfolio because there is a group of companies, about out of 10,000 on that list, there's about 44 we've identified which just follow a very simple rule, which was the rule I showed you earlier, and I'm going to repeat it. This rule, that basically when there's a daddy bear, and when this goes flat to rising, if you buy at that point and you sell at this, over the last 7 to 10 years, they've followed that rule rather well, not guaranteed, but rather well, and consistently, as a result of which, forget fundamentals, made money. Their fundamentals look good as well, but they happen to have followed this, and their fundamentals look good. Of those, if there's some which don't tick all my boxes of value, growth, income, cash flow, croaky, but still follow that rule close enough, then they'll end up in the portfolio. For instance, an Oracle could, because maybe it didn't hit all the greens, but has been following this rule so well that you think, yeah, I think I'll take that. But you can't see the screen. Can't see anything but can hear. White screen. Lost video. Okay, let's give it a second. The video could be lost. It might come back in. Give me a second. Oh, yeah. Let me just do that. 1 second. Not sure. It's really playing up today, isn't it? The broadcast. Let me know if it comes back. The video. In other words, what I'll do is let me do this. Right. Can you see me as a person? Hopefully you can see me. Okay. Let me know if you can see me or not. It's back. Okay. And I'm going to share the screen again. Okay. I don't know why it's happening. I mean, as you can imagine, we don't own the internet or any of the tools we're using. So when we're using, this is Webinar Jam, the back end of it is Google Meets. We're in the hands of Alphabet, Microsoft, and everybody else when this stuff happens. So apologies if that is what's happened. But let me know if you can now see and hear me. Okay, I'm back now. Let me get on with it. Okay, with the rest of the stuff. Let me just see, because I don't think it's focusing on me. Hopefully that focus is a bit better as well on me. Now, you should be able to turn screen share. Let me know if you can see this, the chart. I'm going to put it back on because I think we're having problems with a lot of stuff. No, I think the charts stay in the market, but just let me know if the chart's there, because it seems to be coming off. It seems to be coming off the chart and then coming back on for some reason. And I'm sorry about all the IT problems, which we don't normally have. Right, let's see if that works better. We can see it, Alpesh chart full of scribbles. Okay, good. Weirdly enough, I can't. Let me know if there's a problem, and I'll keep an eye on all of this. I'm going to move that from back there as well, because you don't need it back there. It'll be distracting. So just going back to that S&P point, those are the 44, and that's another reason why they might end up in there. There is one more reason they could end up in there. When we analyze for private clients what hedge funds have bought, and hedge funds which are generating 40% per annum and have bought a new company, let's say an Oracle for argument's sake, and it meets our criteria, then it might end up in our box as well, equally, or in our portfolio. There's another way it might end up in. Bank upgrade, say Goldman Sachs has just upgraded, say Oracle, and it meets our criteria, then it might end up. But the hedge fund one's the most interesting one, because we only look at hedge funds which have generated 40% per annum every year for the last 3 years minimum, and then they've just bought into something. So, and it meets our criteria. So there's various ways in which things can get in to the portfolio. To answer one of the questions I think earlier, how did you know on something? Now, UK, these are the stocks in the UK. I'm not going to go into these here. I'll do a separate one for the UK. What I'm going to show you is I've created this free tool, which I absolutely love. Okay, so I'm going to show you this, and I'll give you the link to it in a second. It's completely free, all right? The portfolio stress test and sequence of returns calculator. And before I do that, I'm going to show you this, because everybody should have this, and I created this a couple of days ago. Now, let's say you've got starting amount of, I'm going to put a small number in, 250,000. Doesn't matter if it's dollars or pounds for the moment, okay? 250,000. Let's say you just do an index tracker like the S&P 500, okay? And let's say the S&P 500 continues to grow, which is a big if, like it's done over the last 15 years. So you get 15% per annum. But let's say you don't. Let's say you only get 12.5%, okay? That's a big if. It's a big assumption. You can play around with these numbers, okay? And I know 250 is a small number. You can always increase it or play around with it. And let's say the volatility is the same, which is 15% for the S&P. let's say you're going to continue contributing. Well, I'm just going to put 1,000 a month in, okay, which might be a bit unfair. It might not be. And for the next 10 years, you're going to contribute. And so you're going to start withdrawing, i.e. stop contributing at 65. So that implies you're 55 now, and you're going to live to 90. So what's the safe amount of money you can start withdrawing at 65 if this is where you're starting? So this works it out. Okay, it's completely free, this tool. I'll give you the link. Safe withdrawal rate is 7.75. Annual withdrawal would be 230,000 a year. Monthly income would be 20,000 a month, right? Okay, but there's some caveats. What if it doesn't grow at 12.5? What if it grows less? So let's say it only grows at 7. Okay, then we'll do the safe withdrawal. Calculate over 10 years of contribution, start with $250,000. Then your monthly income gets a lot more reasonable. It's only 8,000 a month. And you might say, well, that'll do. Starting at 65, 10 years of contributions. Don't forget you added contributions as well. Okay, success probability 90. That's based on what's called a Monte Carlo simulation. Now, I'm afraid there are no guarantees, obviously, because remember what we said, 7% growth rate with a volatility of 15%. What if you've got a load of bad years? Okay, what if there were a load of bad years? You might end up with a little as, if you scroll over it, you'll see there. Age 90, 90th percentile, highly unlikely, you end up with 4 million. 10th percentile, 10% of the time, when you've got those kind of returns with that volatility, you only end up with next to nothing. Okay, that's why there isn't a guarantee as to those. And it's why, as you get to your withdrawal age, guess what you start doing? You start going more into bonds, right? But that's your withdrawal amount and so on and so forth, and what would happen as you go forward. And the other assumptions are in there. Withdrawals are adjusted annually for inflation. Returns follow normal distribution with specified volatility. Portfolios rebalance annually. Okay, so be careful. There's a lot of assumptions in there, but there's your withdrawal rate and percentages. And there's a separate one I've created, okay? And obviously, as people get more into retirement, they might take more into cash and not have it in a portfolio. Let's say, again, there's a load of questions, I think. Nope. Oh, no, there aren't. I thought there were. Sorry. Apologies. Let's say instead you have 250,000, and you can play around with this. 250,000, again, I'll start with that. And let's say your annual withdrawal rate, you want it to be 4%, so you fix it a different way. Your expected return, again, you just did the S&P 500, and I'm not saying it's going to do that again. A lot of people say it won't. Inflation is 2.5%, volatility is 15%. How many years in retirement? 30. Let's say you're doing it yourself, so your annual fees are negligible, okay, because you're doing it yourself. Your starting age is 65. Tax rate, I'm going to put it 0 because I don't know your individual tax bands, and let's assume this is what's sitting in your ISAs and your pensions, and God knows how much you'll withdraw when you'll do it. So let's just assume without, you work your own tax out with your accountant. Then on a stress test, this is what a sustainable real income, 9,840, not great. Worst decile, 18 years, median. Terminal wealth 3.5 million. Anyway, it shows it like this and shows most likely, least likely. Well, wait a minute, why isn't it guaranteed? Because it's not bank interest. There's a volatility to those returns. If it was bank interest, there wouldn't be a volatility to it. Anyway, so what's this actually saying? Well, what it's saying is if you get an unlucky sequence, you'll have nothing left. What does that mean? It means even though what you own is generating on average 12.5%, because you're withdrawing 4% per year, if you get bad years first, still getting an average of 12.5 return, but you get the bad years, where a bad year might be negative 25%, and you withdraw 4%, and you do it again, and you do it again, and that keeps happening. So, because it's 30 years of this, all the good years were at the end, you depleted your capital earlier. Do you understand? So ideally, if you're withdrawing money, it's better to be in a position where if it's a down year for the market, if you can avoid it, don't take capital out of your portfolio as a general rule of thumb. This is complicated. It's complicated to explain, all right? But what I would say to you is play around with it and read the stuff around it, and you'll sort of get a better understanding of all of this. It is not individual financial advice. It's a tool on there, but it just shows you that if you get the bad years first, even though you've got an average of 7% or 14% or 15%, if you get the bad years first and you withdraw money, then you're less likely to end up with the targets. And look at the variability, which is one of the reasons why when you don't want variability, you gradually, as you get older, hold more and more cash because you want less variability. But this is just talking about the money that you might keep invested. Okay, it's on alpeshpatel.com/links. You'll find both those calculators there and a few others like how much you might. They're all free, and there's a ton of other free links as well. Okay, they're both on there. So let's continue with some of this. Where's the FTSE 100? Well, it's chugging along nicely. It's at all-time highs. Why am I not invested in it? Well, in the past, I've had the ETF in it, but I'm just more exposed to the US markets. As I've said like I said, I say this all the time, my first ever Financial Times column I wrote, I'm selling my UK holdings and only buying US ones. That was 1999 when my first column was done. Okay, as well. Thanks, kid. Remember, it's a rough and ready tool, and you only need rough and ready. You know, I thought about adding to those calculators tax things and all of this, and I thought, do you know what? It's going to put people off putting something in because they're going to go, oh God, I don't know my tax rate. I don't know this. Let's just work out stage one. What's the gross amount? And then stage two can always be, let's speak to an accountant and ask them. I mean, I speak to a bloody accountant. I don't work it out myself and say, look, what's the impact and so on. But at least you get a broad idea. And the good thing is some people discovered, oh, I've got enough because it's going to grow. Or others discovered, oh shit, I'm with St. James's Place. I ain't got enough. I'm screwed. But the great thing is you can play around with the numbers, and an image paints 1,000 words. So instead of reading lots of text, if you had this, if you had that, and reading the Sunday Times going, oh, well, here's an article, here's an article, here's an article, I'll read all these and try and do the maths yourself. Because you can just play around with the numbers. You can, get to solutions a lot quicker, I think. Apple. Look, I don't like analysts, or whatever this is, point number 8, 9, or 10. I don't like analysts. This is the average analyst price target for Apple. Now, you might say, well, do analysts, how accurate are they? When they've said there's very little upside, like down at these periods, what's happened to the stock? Has it tended to go down or sideways? And when they've said there's lots of upside, has it tended to rise? I don't know. You look for yourself. I don't have that as a trading strategy or as an investment strategy. If the analysts are saying there's more than 20% to the upside, you buy the stock. And if they're saying there's less than 5%, you sell the stock. That might be a good strategy. You might want to do it. But how many can you have? So my point is, there's lots of strategies. You don't have to chase all of them. Have one or two and be consistent. And secondly, generally, analysts tend to be upside biased. Okay, so you can formulate as many as you want. Warren Buffett owns this, so do I, as you know, right? Amazon, similarly, they say on average, the lowest analyst forecast is 230, the highest is 300, the average is 264, okay, which gives you a 13% rise. I don't care. Now, do I own leverage in those stocks, those familiar names I mention all the time? Yeah, if those who've been following me know that I happen to have leverage versions of those as well. But that doesn't mean you should, because I can take that leverage given that I know the likely movements that they have historically. And I'll show you where we get some of that in a second. Okay, so just be warned about the leverage side of stuff. When we're looking at exchange traded funds, and I'll show you how we do it with them, we again will go through, and again, clients don't have a heart attack. None of these meet our requirements. We'll go through their movements over the past 1 month, 3 months, 6 months. Volatility, I want generally to be quite low on these. And Sortino, I want to be very, very high as possible. And I need them all to be green. Okay, and then I don't care what they do. People say to me, what's your view on emerging markets? They look top down. I don't look top down. I look bottom up. I don't care what they've written on the tin, because they lie on the tin. Okay, they lie. They will say words like artificial intelligence, and yet they won't deliver the results. Or big data sounds so sexy, Alpesh. You must want it. But if it's not generating the results, by the way, I don't own this, but it is rather good. Okay, hits my criteria. But that hits my criteria. I might be happy with 7% in 3 months or 3% in 6 months. You might say 3% in 6 months and get better than that in a bank. Exactly. So be careful with exchange traded funds that will, even if they meet your criteria, because they're baskets of stocks, they tend to have lower volatility and therefore lower returns, that they're meeting your return goal. Okay. So be careful of that as well. Now, I want to show you something else on here. I'm going to bring a whole load of other stuff on here as well. Here's a good flow chart I've given clients. Clients, they're not stocks, they don't have a panic. Okay. I say to clients, this is a pretty good rule. If it's a model portfolio, if it's having a flow chart stops you, put it on your desk, stops you getting confused, stops you doing stupid things like bumbling around and not knowing what on earth you're doing. Okay, so for me, flow charts are important. Here's another very important, because the most important thing I get asked is, what do I do with my portfolio? Here's another important thing. Again, clients, don't have a heart attack. This is published in my books. It's not giving people, the holy grail of the Excel spreadsheet, which is the holy grail. Okay, ask yourself these questions. This is what I say to people. Okay, I want to make sure everything is this part. Jacob, brilliant. What should I do? Now, this will stop you gambling on narratives and news. What it will do is it'll make you focus inwards on, how do I mitigate my regret and buy something based on my risk appetite? Because the two things, which I'm going to show you in a second, which make people mess up their portfolios, and I don't know if this is point number 9, is panic and boredom. Okay, now I'm going to give you a warning. 2021, Microsoft went up 50%, but in 9 of those 12 months, it dropped or was flat. Why did most people not make 50%, even if in January they held Microsoft? Because they got bored or they panicked. Or they were St. James's Place and they had 0.00001% in it. Why do those IFAs, wealth managers, not give you the growth that you so badly want? Because they're trying to mitigate volatility so you don't complain. And when you mitigate volatility, you naturally have two options. Either you buy something which has got low growth, or you put very little money in it. So to mitigate volatility on the portfolio, they might have a good company like an NVIDIA, but they'll buy so little of it. Okay, because they don't want the panic that you're going to otherwise face. So they won't ever give you the growth. It's just built in. It's hardwired in. Okay, now I'm going to show you something. I'm going to teach you some really important stuff, which I show my clients. Well, first of all, this is, again, I don't want clients having a heart attack. They don't need to have a heart attack on this. It's what Warren Buffett earns. What's really important about this that I want you to know is, after his first 5 holdings, and same with Bill Gates, his first 5 holdings, everything else is less than 5%. In other words, it's a very concentrated portfolio. There's nothing wrong, as Warren Buffett famously said, putting all your eggs in one basket, as long as you watch the basket. If you're not going to watch the basket, then you've got a problem. Okay, so I'm going to show you why. And people get this wrong. They go, oh my God, he sold a bit of Apple, he must hate it. No, as he rightly said, I own a ton of Apple. Why does he own Apple and Chevron? I've wrote an article. People think, oh, he must like Chevron. No, because they just fundamentally don't understand how these things work. By the way, this is on the blog, which again, alpeshpatel.com/links or campaignforamillion.com/blog. That bit I showed you about the withdrawal order. If you want to get rich, learn about this. It's a small article. It's a really small article I've written where I show you why it matters about the order in which. So try not to withdraw money in a year where the market's down. And it's that tool that I showed you earlier, the free one. This is the article that goes with it. It's so important. If I had to teach you anything, please look at that. I had one prospective client ask me, can £1 million portfolio yield 200K in dividends? I thought, are you crazy? What are you talking about? Sometimes private investors have these kind of crazy questions. And then she said, yeah, but I've heard about these dividend ETFs. Can't they do it? So I wrote a whole article. It's on there, okay, on campaignforamillion.com/blog, okay, where I've broken it down and we've looked at it all. And I said to her, I don't know where you're learning this nonsense. It goes on the internet. I've seen loads of videos where I can make loads of money on dividends alone. And then I've broken it down by all of this. I mean, you know, and explained to her that, no, sweetheart, it was a woman. You can't, okay? It's not that I was being patronizing because it was a woman. I mean, if it was a bloke, I would have said, no, buddy. So have a look at those. They're incredibly important and they'll explain a lot of stuff. This is just in 7 days. That's my output in just 7 days. So they're, you know, it's a really good pint size. But the point I also make, I don't think it's been published yet, so apologies for that, but it will be probably today, why Buffett owns both Chevron and Apple. And it's not because he thinks Chevron's going to do well or Apple's going to do well. It's because he knows when you combine those two, you get a better return and it dampens the volatility of Apple. When you've got that much Apple, it makes sense to have a Chevron. and I write this in an article. It's too complicated to explain here at the moment, but you'll get it. And that's how wealth is made. Okay, it's having that right mixture in portfolios, and it's why portfolios are incredibly, incredibly important. When it comes to model portfolios, and we show these to clients, I'll give you an example. Let's say we are looking at a model which is the quality 5 plus. Okay, so let's say you're looking at the quality 5 plus. Now, this is where my client's going to have a heart attack. Don't worry, I'm not revealing the numbers. What I'm saying is, this is what we want to be trying to get. Why do we want to be trying to get that? And hopefully we're still looking at this. I know, Jacob, I know, not, but she asked it. And I thought, and because she saw some YouTube videos, I thought, what planet are you on? Anyway, this is what we want to do. And this is really important. So point number 10, when you're looking at an individual set of companies and you put them into a portfolio, then you've got to look at the portfolio. And then you want to say to yourself, I've not looked at the history of this portfolio. It looked great today, but how did it do through crash tests, like a crash test dummy car? How has it done historically? And when we do that, what we then do is we look, well, okay, since 2017, it had a couple of car crashes, 2018, 2022, but it survived. It still generated 31.6%. Then we say, what if we halve that? What if we only going forward do half as well? Because the world's changed. So we never knew what it did historically. We knew what it did in the last set of accounts, balance sheet, cash flow, value, growth, income. We said, what if we halved it? Well, 15% per annum doubles your money in 5 years. So we think, okay, half of it's fine. Do you see the buffer we need to have? It's 100% buffer. If we want to double our money in 5 years, we want to try and get 31% per annum historically, because the world might be more risky or whatever. But the more important figure is this one, the drawdown. Now, I'm going to show you something, why the drawdown's important. Again, great investments program clients that don't have a heart attack. No names are disclosed. Okay, so I don't want you to have a heart attack. Okay, this is important because this is, remember I told you about panic and boredom. Panic and boredom is what causes you to lose money. Remember, this is a 31% per annum portfolio. Panic and boredom, even if you've got good companies, you'll mess it up. Why? Because boredom sets in when you're underwater for a long period of time. Oh, Alpesh, I haven't made any money. It's been 6 months. This is called the boredom column. It's been 11 months. It's boring. Okay. And drawdown is panic. Oh my God, I'm down 13% in just 3 months. I'm throwing up. If you've got a good, resilient company, it's why Warren Buffett and I are so incredibly smug when the markets fall. We'd say to ourselves, well, they're good companies. I'll either buy more or I might get out now and buy back a bit more expensive later, or hopefully cheaper later. Either way, I'm happy and I'm smug because everybody else is panicking. Okay, but I know they're good companies. That's the mindset to be in. You can only be in that mindset if you've got good companies in a portfolio, not individually. Oh, that's a good one, that's a good one, that's a good one. And guess what? When they play as a team, sometimes the volatility might accentuate. That's why I was saying earlier, I want you to look as it as a portfolio, not as individual stocks and how they behave as a portfolio. Anyway, so panic and boredom are the two things which will make you mess it up. What's incredibly important, I mean, this doesn't matter so much, is, okay, well, how much might it grow? And this is the other thing. Because we're not guaranteed the future, we can at least look at statistical movements, like flipping a coin. If you flip a coin an infinite number of times, you're guaranteed 50% heads. But if you flip it 5 times or 10 times and do this experiment, it's going to vary, isn't it? You might get 10 heads, you might get 0 heads, but do it an infinite number of times. So give your portfolio, as long as it's good companies, long enough. Now, we generally would say either 12 months or preferably 3 years, okay, is an ample time. And then we can always review, or you can change it after a year. If you hit the top decile and you almost double your bloody money in a year, you might say, right, let's pick a new fresh bunch of companies because I think we've exhausted these. Now, these are little subtleties on what makes money, which is often lost, which is why I wanted to share it, okay, with you on there. And like I said, I ignore analysts. Now, I don't own Novo, just to be absolutely clear. I don't bottom fish. There might come a time, I think there will come a time when I'll buy it, but it is not now. So don't be a premature buyer. Point number 11 or 12 or whatever it is. Check out Alpesh Superb. So now, I have some clients and he's going to say, no, you go for it, go for it, go for it, go for it. Thanks for the link to my son's work. No worries at all, Jacob. She's a good one. I know. Well, I'm giving her education. I'm showing her the articles and I'm writing articles for every question she has. Synopsis. This is an important reason you need a portfolio. My wife has this in her portfolio. And you might say, well, she's married to you. Oh my God, she'll want a divorce. Why has she got this? No, it's 1/44 of a company. of a portfolio. Why? Well, because the reason we don't pick just one stock, Warren Buffett famously said, if you can't handle a single stock dropping 50%, you have no business being an investor. Because even what he's saying there is, he can't guarantee that all his stocks are going to go up. He just can't. So some of them might drop, but because it's in a portfolio, it doesn't matter. And because they're good quality companies, it doesn't matter. We're not there saying, oh, look, phew, what a relief. Morgan Stanley said buy on 9/11. Or Bank of America said it the day before, sell. Who's right? Who's wrong? Well, Goldman Sachs said buy, and Bank of America said sell. Well, thanks, analysts. You're bloody useful. Bank of America said sell. Goldman Sachs said buy. Morgan Stanley said buy. What does it mean? I couldn't care less about the analysts. But the point is, portfolios are important. Otherwise, you're going to have panic attacks. Otherwise, what you're going to say is, Alpesh said synopsis and it dropped. That's why you're looking at it completely the wrong way. It has to be a portfolio as a whole. It's fun doing individual stocks. It's a parlor game. alpeshpatel.com/links is where you'll find all the stuff, including model portfolio examples, pension calculators. We've got another pension calculator, which I really like, which I created for students. For people, free. Okay, so here it is. And you can put in current age, retirement age, current savings, monthly contributions, and it'll project. It'll give you pension projections. But because it's based on there's pension based on 4% withdrawal and volatility can happen. You've got to be just a bit careful that it's not guaranteed, obviously. 7% isn't a bank account, okay? It's based on stock market. And so you're looking at what roughly you should be able to get. So have a look at that. And it's all on alpeshpatel.com/links. I've got a bit more to go, but this is sort of like a little commercial break. Do follow me on my YouTube channel. Should I tell you something funny about YouTube? Okay, I'm going to show you the statistics of apparently how much I make on YouTube, which people ask me, why are you on YouTube? How much do you make? Where's it gone? No, is it here? No, that's not it. Oh, it was telling me a moment ago, earnings and stuff. Is it here? Nope, that's not it either. Oh, anyway, earlier it showed monthly earnings. And I was like, I don't have those monthly earnings. I don't advertise anything. I don't have commercials on mine. And it said typical monthly earnings, $7,000 a month. Anyway, that's what it said. I was thinking, that's BS. Because I don't have commercials on. I guess it means if I did have commercials on. Anyway, there's 255,000 followers and a lot of good education. What I would tell you to do, and we've revamped it recently, start with this, fix your pension here. There's 192,000 people who watch that. And then the weekly stock market updates are over here and stuff. So you can watch those as well. And then there's investing basics. Those are the three main things, unless you want to watch my TV appearances. Okay, so I've made that simpler. So let's get back to the markets. Okay, now the analysts think there's a 33% to the upside. Fine. I don't care what the analysts think. I don't care. Oh, no, don't say it's gone. Again, no, Ronnie, there was no stop loss. It's part of a portfolio. It doesn't need to be a stop loss. The portfolio was tested over a 5-7 year period. And as a portfolio, it went through crash periods where individual stocks in the portfolio can drop 70%. So what? As Warren Buffett sometimes have. There doesn't need to be a stop loss. We're not trading, so there doesn't need to be a stop loss. Stop loss is if you're trading. Screen's gone blank as before. Again, apologies. Let me see if we can do that again. I'm going to see what the problem might be for next time. I don't know what the problem is. I will ask AI what's the bloody problem. Does that work? Okay. Might be that. I wonder if it's some kind of bandwidth issue. I mean, the computer is pretty bloody strong. It could just be webinar jam at their end having a problem. Okay. Oh, so I think that's your lot for the moment. Discard. Okay. Any questions? Let me answer any questions, and then I'm going to leave it at that because I know we started late, so I'll finish late, but which is entirely my fault. So if there's any questions that I can answer as well. And I've got a Telegram channel, public Telegram channel, where we've got 4,300 people on there. It's completely free. And you'll see, it'll alert you with my daily in the markets and the portfolio stress test, everything that I tell you in the weekly. If you can't make the webinar, okay, it will just give you an alert on Telegram, which can be on your desktop as this is right now, okay, as well on that. If there's no questions, I'm going to go. I had a migraine yesterday and I had to cancel a load of meetings today as a result. Just not enough sleep. Get sleep, people. I bought Whoop. Let me go back to, so there's all of that. If you want to be part of the program, it's alpeshpatel.com//shares. Okay, for those who think, well, actually, yeah, or if you want to have a call or whatever else, that's all on there as well. And you can see why and how we do things the way we do as a result. So whilst it's sexy saying here are the individual ones, it's the portfolio that matters, because you can have something like MicroStrategy up 515%. And I wish I was clever enough only to have bought that, but the portfolio as a whole only did 41. Why? Because we didn't put all our money in there. Why didn't we? Because we don't have a crystal ball. I wish we did. Similar to 2023. Okay. The portfolio as a whole didn't do as well as some of the individual stocks did. We didn't have a crystal ball to put it all into an individual stock. 2022, we had to be in cash most of the year, and the market fell anyway during that period. Okay. Similarly, you might only get that. Now, there's been some very good years, so these numbers look good. It's not because of me. It's because the market's been rather good. The markets have been rather good. What is your strategy when the S&P tops out? Oh, it's the Daddy Bear rule. I've written an article about it. It's on it's on my campaignfor1million.com/blog. It goes into detail what that rule is. Just go to the blog, scroll down, you'll see there's an article about exactly that. What is the S&P? What's the 2025? Oh, for us, let me look that up. It's a good question. I just posted that for clients. I'll have to look that up. Let me look that up. I think I put it in I put it in last week's market update, or the week before. Let me pull that up for you on screen. So we've got that. Give me 1 second. Weekly market update. Oh no, that's private client one. So I'll answer that in just 1 second. I'm trying to think when I did the last one. Oh, here we go. It's a good question. I'm glad you asked. So this isn't all our model portfolios. This isn't all of it, but that's the performance on. I'll put it up on the screen. Give me 1 second. I'll put it bigger on the screen so you can see it without hopefully destroying all the visuals. Whoops. I think there is something wrong with the screens. Anyway, can you see that? Can you see that? So year to date on the Quality 5 Plus, it's up 14.92% to September. So it doesn't include 19th of September, obviously. It doesn't include September. It's up to September, so up to September the 1st. The S&P is up 10.72, which has got a lot to do with it. The FTSE all share is up 13. These are other model portfolios of various people and so on. And yeah, so, and you can see historic what's happened. And yeah, so that's that. S&P is currently up 13. Yeah, but you're counting it year to date. This is up to September the 1st because we update this monthly, not live. I suppose we could do it live, but that somewhat goes toward the and ours will be up more since then. So we might be up 18 now. I don't know. It was a 15 then. It might be 18. But I don't care what it is day by day, month by month. It's really year by year that matters. Dinshaw's portfolio stocks, he's more risk loving, so he's willing to take a lot more drawdowns. He takes more risk than I would, and I tell him that. I think he's crazy. But his portfolio stocks were higher volatility. They were large cap companies, massive companies. And he also, so he had just more leverage. He had more drawdowns risk, which is more than I'd be willing to take. Let me put it this way. Imagine he just had NVIDIA and MicroStrategy, for argument's sake. Imagine he just had Bitcoin, which he doesn't. Okay, it's like that. How did he do so well? Well, that's why, because it was high risk. And you might think, and here's an important point, you might think, oh my God, I want to be like him. He's so amazing. No, because the falls is what will kill you. The panic will kill you. And trust me, it will. You'll say, no, I won't. I promise, Alpesh. Please, mummy, give me the gym membership. I'll get a six pack, and you get the gym membership, and you don't. You'll panic. You'll throw up. I know you will. Okay, so trust me, it's not for you. But Lee was 12.5 if they were both. Yeah, because they all have. Yeah, because it's bespoke. Each person chooses their own model portfolio. You don't say to everybody, you're all the bloody same. One person could be 70, the other one's 22. One person says, I don't want any drawdowns below 10%. Another says, listen, I don't care what the drawdown is because I'm not going to be selling it. I need high octane returns. Do you see? People are different. It's bespoke to every single individual person. And that's, they're different. They're not copying me. I mean, if they want to copy me, it's simple. I tell them, if you want to copy me, my wife and son, there it is. That's the cake we eat. Well, why is your cake different to theirs? Why is yours not the very best cake that there is? Because I don't want Tesla, for instance. I don't want Tesla. Do you get that? I don't know why people don't get this. They don't realize that money causes, some of these rides cause an ulcer. I don't want a bloody ulcer. And you too will panic. You too will panic. You know why? Because if I said to you, give me all your money. I mean, by the way, I don't take your money. You manage your own. I say, give me all your money. Don't call me for 10 years so you don't see all the ups and downs. You'll say, wait a minute, mate. I'm giving you my money for 10 years and you're not going to even tell me the monthly performances or annual because you say it doesn't matter how they go up and down. You might panic. I don't want you to panic. Just leave it with me for 10 years. Would you do it? Of course not. Similarly, if I have, for argument's sake, Tesla, and I look at it, and I know I shouldn't look at it for 5 years. Well, with Bitcoin, Ethereum, and Ripple, which I own, I'm not going to look at them because, of course, I'd have a heart attack. I don't want a bloody heart attack. Thank you very much. So, yeah, that's why everybody has to be bespoke, and they should be. If you want a bunch of free reports as well, you can find them here on alpeshpatel.com/shares. It's all on there as well. Okay, guys, I think if there's no questions, then let me know. Oh, I think there might be some private questions. Oh, there's a bunch of other files I want to give you as well. So I'll give you some files. The book you should be able to download as well. And if you want to learn more about the approach, alpeshpatel.com/links. alpeshpatel.com/links. It's all on there. Okay. My ambition eventually is to make sure that nobody uses IFA and wealth managers, but have the education to do it themselves. When I grew up in the 80s and Margaret Thatcher wanted people to own shares, I want people to own shares because it's the quickest, easiest way I know of making money, as long as you don't mess it up. And messing it up is panic and boredom. So you need the good quality companies. There's a whole bunch of free preview stuff here. Okay, understanding the ideal investment, why your IFA and wealth managers provide disappointing returns. alpeshpatel.com/shares. It's there, and it's free preview. You can read all of that. So if you want your free preview, it's all there. All right. No, the Quality 5 Plus. The clue's in the plus. It's 44 companies, but there is a version which a client made of 25 companies, and it actually did. I think it did better. And you might say, well, why don't you just use that? Well, because some clients like sprinkles, some like icing. I don't mind if somebody has a portfolio better than mine, because mine is suited to my wife's risk appetite, and my wife's risk appetite is different. And as long as she's happy, I'm happy. I don't ever say to her, listen, little lady, let me handle the money. You just keep washing the dishes. I know what I'm doing. I don't know why I put an Australian accent on there. Forgive me, Australians watching this. But yeah, so it's 44, but one client made 25 companies in there. Honestly, it's not even the portfolio which is going to make you the money. It's the avoidance of panic and boredom. It's the bit you don't see. You're looking at the portfolio like this. You're looking like this. The bit that's going to kill you is the bit you don't see coming this way. It's the panic and the boredom. And I can tell you that time and time again, because I've seen it happen time and time again. Let me put some more lights on so you can see me more clearly. Okay, let me turn that thing. Oh, we've got the presentation back there. Okay, so let me now see. I turn that screen off. You should all be able. Ooh, that's probably a bit too bright, isn't it? Should all be able to see me. There we go. I'm going to leave it at that. Hopefully you've enjoyed it as well. And do have a look at the links, as I said, in the bio. I will post a copy of this up. Just before Deepak messages me and says, why did you show the Excel? I didn't. I showed the things around it because obviously I can't show everything. Okay. So there we go. Thank you. And I hope the education stuff, I know it seems boring. because everybody just wants the dopamine sugar rush of buy this stock, buy that stock, or whatever it is. You know, they want me just to say Walmart, Costco, and all the rest of it, Coca-Cola, Pepsi, Philip Morris. But actually, it's especially in a market which is overbought like now, it's not about the individual stocks. It can't, because the volatility is just going to smack you between the eyes if you make it about the individual stocks. So it's critical that that doesn't happen. Okay.